trading in a volatile marketplace. Now, in trading, and this is something that's very important, I say volatile market. Okay. Some people think, oil is volatile right now because everything going on with Russia and Saudi Arabia, and so oil is volatile. Yes, economic situations can make or give price volatility, huge jumps in one direction or another. But the overall feeling of a volatile market doesn't necessarily, or a market is volatile, means it tends to swing more in an average day of trading than it would swing in a very slow market. It doesn't mean that something necessarily happened in the fundamental world. So volatility is a measure of how price or returns are scattered over time for a particular asset or financial product. It is a key metric because volatility creates profit potential. However, trading on volatility can also create loss if traders do not learn the appropriate information and strategies. The price action is a measure of volatility. Traders are therefore trading volatility at all times and creating it with their transactions. By watching how far or how fast price moves, traders can gain insight into whether the price move is likely to sustain itself or if the move has run its course. Now, through understanding volatility, you can create appropriate trading strategies that will help you harness the potential profit. This can be done by trading volatile assets, tracking changes in volatility to aid in selection, incorporating volatility-based technical indicators of software, or by focusing on low volatility assets. If you want, hypothetically, lower risk or a more measured trade, you've got your own trading strategy, okay, of not for volatile markets. And when you see price do this and you see you don't necessarily want to go into a volatile market. The more volatility, the bigger the swings are, the more risk you have, because the farther away you have to put your stop loss, and the larger the risk can be with the big swings in the market. Volatility is an important metric for all traders, including short-term day traders, swing traders, whose primarily focus on daily or weekly price movements. So how is volatility created? How is it traded? You can trade on volatility across various markets and timeframes. We're going to look at volatility trading strategies that can be applied to shares, Forex, and commodities. Now, I leave out of this equation cryptocurrencies. The only reason is the cryptocurrency is an extremely volatile market. But nobody has really been able to figure out how to interpret it yet. Volatility is a much more drastic move in the cryptocurrency markets. And because cryptocurrency markets on the whole they're not tied back to an economy. And as much as people want to convince you that if gold goes up, the Bitcoin's going to go up, and the dollar goes down, or the S&P goes up, there's always people telling you all this. Nobody's kind of figured it out yet. When the markets go crazy and Bitcoin goes up and gold goes up, everybody says that cryptocurrency is a safe haven, just like gold. We just haven't deciphered it yet. So overall, you have to figure out differently when you're trading cryptocurrencies how to interpret their volatility. Now, the volatility indicators that we have work well for cryptocurrency. You just have to figure out differently how you're going to apply them. So with a disciplined approach, you can learn to manage volatility for your advantage while helping you minimize risk. So here are 4 steps you should consider. Find opportunities to trade volatility. A fundamental understanding of the forces driving each market can help you forecast volatility in a specific asset or sector. Now, one The US stock market react much differently than the commodities market to an election in the US. You know, different markets react differently. You know, the stock market can go into risk off. And what happens when the stock market goes into risk off, all the risk assets go up. The Japanese yen will go up, the US dollar will go up, gold will most likely go up because they are risk off. They're where you go when the S&P turns to risk off. What happens? The money that's tied up in the S&P when people are selling to get out because it's becoming high risk has to go somewhere. So they tend to move that money into US dollars, Japanese yen, into gold for the time being. This money has to go somewhere at all times. It's like energy. It's not, you can't create it or do away with it. Yeah, you can put it in bank accounts and not have it in the market anymore, but it tends to be, if there's billions of dollars being traded every day, tomorrow, even the market might be maybe risk off. There's still the same billions of dollars tied up in the market. It's just shifted markets. So a fundamental understanding of the forces driving each sector can help you forecast volatility in a specific sector or asset. However, there are other technical tools that can help identify potential upcoming volatility in almost any market. For example, tightening price action with shrinking Bollinger Bands indicates that volatility is decreasing, but often precede a sharp rise in volatility. In this situation, traders look for a significant breakout from the Bollinger Band to signal that a surge is in a directional movement may be underway. Let's pop up a live chart and let's take a look at Bollinger Bands. Let me get my charts up here. Uh-oh. Hold on one second. Sorry about that. Okay. So that's okay. Here we have the Euro US dollar 4-hour chart. Let's drop on here some Bollinger Bands. It's a very good indicator for many things, but the width of the band from here to here tells you how much volatility is in the market. When the bands are contracting, getting narrower, the markets have less volatility. When the bands get wider, they have more volatility, because if you look right here and right here, they're about the same length because the volatility's dropped out of the markets. Now it surged back into it the next hour, but look what happened when that volatility surged. We got a huge downtrend. But we use Bollinger Bands for other reasons, but it's one of the main things we can see in Bollinger Bands. And one of the most common trading practices to use is what we call the Bollinger Band squeeze. So a lot of times, right now we have volatile markets. We have craziness in the markets. We have assets tumbling, the Euro US dollars. Well, look at this. Euro US dollars trading at 10056. Unbelievable. Markets are tumbling. Okay, now, that tells us the US dollar is gaining a lot of strength and the euro is losing very badly. Okay, we drop Bollinger Bands on Bitcoin. Now we can see that even though prices got up and down, and price is very low for Bitcoin at the moment, the volatility hasn't increased or decreased radically, except in this move where we have the very wide bands, and this move where we got a very wide band when price dropped harshly a week or two ago. So by seeing the volatility in the markets, we can take advantage of that. Now, meanwhile, we have indicators like average true range. It's a technical indicator which averages out the market's price range over time. You can add the indicator to any market over any time frame and will help the historical price volatility over a range in a period that you're looking at. For example, the ATR added to a daily time frame of an index would identify how many points the index is seen moving on the average over the course of a day. The ATR indicator added to a Forex pair on an hourly time frame would identify how many points or pips the Forex pair has moved in that hour. And why is this important to you? The higher the volatility, the more risk there is in the market. The more risk there is in the market and the more movement in a price, the farther you have to set your stop loss and your take profits. So if you're analyzing a trade and you want to enter, say, Bitcoin at $20,000 because you think it's going to go up to $21,000, and you've got a whole trade laid out, but you didn't take a look at it, and Bitcoin's been extremely volatile, and it's been jumping up and down $2,000 every hour. Well, you might have been completely right. Bitcoin had reached up to $22,000, and you would have. But what happened was Bitcoin dropped down to $18,000, and you got stopped out before it ever made that jump to the 22,000 because you didn't set your stop loss far enough. But on the other hand, it takes a lot of cash capital, especially if you're trading on leverage, to be able to cover that volatility. So volatility is the likelihood of a market making major short-term price movements at any given time. Highly volatile markets are generally unstable and prone to making sharp upwards and downwards movements. And to be honest with you, everybody would like to get rich quick. But trading in volatile markets can be very dangerous. We want markets that have a standard range of volatility. Yes, we can have a market that's got some risk off or risk on factor in it. We can have higher volatility, but we don't want a market that's got high volatility because it's too easy for you to lose your butt while you think you're going to get rich. Most high volatile assets typically come with greater risk, but are also greater for profit. And this is what sucks you in. This is why most traders try to match the volatility of an asset to their own risk profile before opening a position. Major driving forces of volatility can include market sentiment and imbalances in supply and demand, both of which can be influenced by economic crisis, political developments, company announcements, macro indicators. Look what happened with Twitter this week. Twitter dropped 6% over Elon Musk. I don't really understand why. Well, yeah, he offered to buy it at a very high price. Then he backed out of the buy. But the fact is, Twitter was quite content before Elon Musk ever showed up at their door. And so the price is going back to where it was in the market before Elon Musk. So this is the type of economic crisis and company announcements that have an effect on the markets. So if you were trading Twitter and you didn't even know, Elon Musk, decided he wanted to pull out the deal, which we probably knew all from the beginning, but you wanted to see when it was going to indicate or affecting the markets. You might have used a volatility indicator because if you wanted to trade, say, hypothetically, Twitter to fall, you wanted to short Twitter, you would wait until that volatility started entering the market, see if all the other traders were getting a little shaky, and you might have done a sell position. So in volatile markets, profits can suddenly vanish and turn into losses. So consider ways to lock in more gains when you can. One approach here would be to lower the profit targets for parts of your position. Or if your stock is moving sharply higher or lower, consider selling a portion of your position while letting the remainder ride to capture further gains. You need to have different rules for a trade in more volatile markets. And you can have, first of all, you always, in a more volatile market, you got to reduce your target price. You got to increase your stop loss. So that means, number one, will it fit into your risk reward ratio? And then if you say, okay, the Federal Reserve's going to do this, so this is going to go up tomorrow. Okay, well, how do you capture those gains in a volatile market? Because a market can shoot up, go all the way down, shoot up, go all the way down in a matter of seconds. It's knee-jerk reactions, but you want to capture that knee-jerk reaction. So how do you do that? I'll give you an example. Last year, Walmart released their, I think it was third quarter figures. Now, on the whole, they weren't so great. They were in range, but at the bottom of range. So all the papers are reading right away, Walmart stocks falling, Walmart. But what ended up happening is Walmart stock ended up ending the day much higher. Why? Well, the analysts who took the time to dig into it realized that their online sales had increased way more than they expected. Their growth in online sales was a lot higher than, and this is where their future is looking to take the gain. So overall, their in-store sales weren't horrible, but they weren't so great. They just were in line. But their online sales were phenomenal. So if you would have sold because the stock's falling because they didn't do so good, well, maybe, and it did fall. It fell immediately a couple dollars, but it turned around later today and soared up and was up several dollars. So how would you have locked in your profit when it fell? So when the markets realized and recovered and changed the other way, you didn't get stopped out and lose all your shirt and lose the potential profit you had locked in. Volatility is arguably the most misunderstood concept in the investing community. While professional traders live on volatility, many beginners in the market don't know what volatility is and how to trade on it. Now, the fact is, we couldn't make any money without volatility because we're trading the difference in the price now to the price later. Now, in the old days when the stock market moved very slow, you have lots of stocks that hardly ever change. How do you make any money? Now, we're not looking for highly volatile markets, but we're looking for volatility. We want something to make General Motors go up today. We want something to make Twitter fall today. Okay. This is volatility because Twitter just stayed at the same price. And even if it went up 20 cents a day, 5 days a week, so it's $1 this week, $1. At the end of the year, yeah, if you bought a couple thousand shares, put it in an investment account, you would have made yourself a nice little bit of steady, safe profit. But we're trading. We need movement in the markets to make our profits. So volatility is a statistical measure of the deviation of returns for an investment or a financial instrument. Simply put, volatility refers to the amount of price change over a given period. The more the price tends to change over a given time span, the higher the volatility of the financial instrument. A highly volatile asset would move erratically and experience impressive but dangerous increases and dramatic falls in price. A less volatile asset, on the other hand, would hardly move at all. Combining financial instruments with different volatilities can also be used to diversify the investment risk in a portfolio. Now, if you're a smart trader and you're looking for or delving into a highly volatile asset, or you're looking to come into a highly volatile market, well, why not look at one asset that will trade one way and an asset that'll trade the opposite? And you will at one point out profit from one and less profit from another. But you can maximize your volatility by finding an asset that would move. If you thought, a lot of times people do it between Bitcoin and Ethereum. Now they tend to move the same direction, but Bitcoin tends to be a lot more volatile than Ethereum. So if you could take a safer risk in Ethereum because it's going to mimic Bitcoin's return, maybe that's a better way to go. Or smaller trade in Ethereum, larger trade in Bitcoin, and different rules for locking in profits. Now, high volatility isn't usually associated with riskier investments, since volatility can work both for you and against you. Trading very volatile financial instruments should be taken with caution. In the Forex market, major pairs, which include the US dollar as either the base or the counter currency, usually fluctuate to a smaller extent and are significantly less volatile than other pairs that include exotics like the like the Turkish lira or the Mexican peso. But for instance, we have a very risk-off market right now. So the dollar is jumping up, dollar's safe haven. Dollar is soaring up by leaps and bounds. Euro's tumbling down. Where would you want to protect yourself maybe in that? If the dollar's got so much strength, we might be trading the euro to go down and taking advantage of that full decline. But maybe we offset some of that risk by trading the US dollar JPY. Because the Japanese yen is also a safe haven. And it's not going to move as drastically as the euro dollar because of the European issue that's going on. I haven't looked at the pound, but I would think the pound is also in a very big risk-off situation because of what's going on there with Boris Johnson. While trading highly volatile financial instruments can be very lucrative, traders need to pay attention to proper risk management when doing so. Using stop losses is mandatory when trading on high volatility in order to have potential losses under control and avoid margin calls. And that's what happens. High volatility comes in the market. You don't have enough money in account. You know, you've maxed out your capital to trade the maximum amount of leverage, and the market's moving against you. Now you know, there's two choices. You can either ride that out, but you have to have the capital in your account to keep, you know, the loss from exceeding what your account is, or you have to let your trade get closed. And the trade can get closed in a very bad position for you. Now, see, if the price moves a lot in a day, especially now we're talking about stocks, especially with lots of volume, this means that a trader can enter and exit the position easily. This is one reason why volatile stocks are so popular for day trading. A volatile stock is one whose price fluctuations fluctuate by a larger percentage each day. Some stocks consistently move more than 5% per day, which is expected volatility based on the movement of the stock. Others stocks may only have certain days where they move less than 5%. A volatility trader can seek out either a consistent volatile stock or one that's simply showing larger movements for that day. When day trading volatile stocks, you can set up a 5-minute chart and wait for short-term trends to develop. For day trading, a 10-day moving average or 10-period moving average will often highlight the current trend. You should then wait for the consolidation with at least 3 price bars that it may have moved mostly sideways and enter the position if the price breaks out of the consolidation in the trending direction. This is a relatively simple and effective way to trade highly volatile stocks. For example, American Airlines stock was moving more than 6% a day for much of the first half of 2020 and often had a large trending days. In this instance, a trader could place a stop loss at 2 cents outside other side of the consolidation. Then a target should be placed at 2 times the risk. The risk is the difference between the entry and the stop loss price. In the example, a downtrend is in progress. Consolidation form with a low at 12.95. So here we can see we're selling into this market. We're putting our stop loss right above, 2 cents above the consolidation price. We take the short, we put our target point here, and we would have traded that volatility down because it had that consistent volatility over a period of time. The day trading strategy could be used in any stock that is trending, but it tends to produce more favorable results in volatile stocks because the larger price movements mean that the target move is more likely to be reached. A more dynamic strategy is to use trailing stop losses, such as a 20 period moving average, which allows the trader to capture large trends should they develop. They should then exit when the stock price touches the moving average indicator line. So we see here, same price scenario. Here we have our moving average. Here we have our target point. Stop loss, enter the market here. Now, we hit our target, but at what point would we have exited the market? Well, to be honest with you, we would have exited the market here because it broke the stop loss. It broke the moving average. So as a guideline, when a major stock index such as the S&P 500 experiences above average market volatility, this individual stock within the index will also most likely see more volatility. And what do we have to monitor that? The VIX. If you look closely, you can see that some currencies and currency pairs are more volatile than others. You must have heard the term safe haven, which refers to some currencies like the Japanese yen, the Swiss franc, and the US dollar. On the other hand, emerging market exotic currencies like the peso and the lira, the Indian rupee, and the Thai baht are considered more volatile than a safe haven currency. So depending on your trading style, strategy, and trading preference, you can always find a currency pair that will suit your trading technique. While some traders prefer volatile markets, others might not like high risk that comes with high volatility. But whether you like it or not, you need to be aware that you need to set a different set of rules. And the best way to do that is if you just drop Bollinger Bands on your chart, you can see what the volatility level is. Okay, maybe you only decide to trade in markets that have low volatility, or it just came off of volatility market and the volatility is slowing down, because it'll help you make your most sensible decision. In simple terms, volatility refers to the price fluctuation of assets. It measures the difference between the opening and the closing price over a certain period. For example, a currency pair that is fluctuating between 5 and 10 pips is less volatile than a Forex pair that's moving between 50 and 100 pips. To understand the relationship between market liquidity and volatility, you need to understand what liquidity is. Now, this is important, but in CFDs, you don't have that problem because you can always close the CFD, because the CFD is a contract between you and the broker, in this case, Alvexo. But if you're trading in commodities that aren't CFDs, or you're trading in stocks, or buying from a stockbroker, there are certain times when the market's moving too fast one way or another that there's not somebody who's willing to take that other side of the trade, and you can't get out. So for most things that you trade with Alvexo, you don't have to worry. And like I said, CFDs, you don't have to worry that problem because you can always close the contract with your broker. So generally speaking, the more liquid a trading instrument is, the lower the volatility, as it takes much more to move in a certain direction. It also makes a difference in your spread. the cost of your trade is the difference between the buy and the sell price. In highly volatile markets, those spreads tend to get a little bit wider because the liquidity provider is asking for more money to provide the other side of that trade. So let's talk about an easy strategy, a volatility breakout trade. A breakout happens when the price of an asset moves beyond its support and resistance levels on a trading chart, which indicates a new trend direction. One way to measure volatility breakout is through a technical indicator such as ATR, average true range, which tracks how much an asset typically moves in each price candlestick. And a sharp rise in ATR can help traders to potential or alert you to potential trading opportunities. So we're going to take a look at a gold hourly chart. And if you see on here, we have ATR on the bottom. We have our moving average on the top. And whenever we have the ATR crossing, that's telling us we have a jump in volume and a potential trading opportunity. When it crosses above, it's telling us we have a selling opportunity. So we have the increase in ATR, increase with the crossovers. And here we see one crossing the other in the other direction, and it gave us a buy. Here we have the opposite again, gave us a buy. So only when the ATR crosses above the simple moving average is there a potential trade. The price could also be breaking above or below recent swing highs and lows for a better opportunity. This helps to filter the times when the ATR crosses the moving average, yet the price does not move significantly. A few examples of trade setup are shown on the chart below. This is mostly an entry technique. Okay. Again, I show you when the ATR crosses above the moving average, we have a sell opportunity. When the ATR crosses above the moving average, we have a sell opportunity. When the ATR crosses below the moving average, we have a buy opportunity. Now, moving averages are common indicators in trending environments. They provide timely exits. So we also see when the price breaks the actual moving average on the chart, that would help us indicate to leave the markets. So as we discussed, the ATR is a particularly effective tool for tracking how much an asset is moving on average for each price bar. Historically, volatility also moves price action. This is a technical indicator that is shown on the euro-US dollar. Implied volatility anticipates what could happen in the future. So here we have our volatility indicator and our ATR. And one is telling us what we could be expecting. So a relative volatility index, RVI, is another indicator that analyzes the direction volatility of price. If the bottom of the indicator shown in the euro-US dollar chart, when the indicator is above the level 50, this means the volatility is on the upside. See down below here? Okay. Above and below 50. Somebody asked, is the trend considered volatility? No, a trend is a price movement. Now, the quality of the trend can be judged by the volatility. A beautiful uptrend that's moving in push, ease, push, ease, push, ease, push, ease should not be creating volatility. But when you have a market that's pushing up radically, coming down, pushing up radically, and is not a very pretty but qualified uptrend, that tells you that's volatility. I much rather would trade a low volatile market with a nice, solid moving uptrend. So like here, we can see a beautiful uptrend, but volatility is very low because this is what the market should be. Push, ease, push, ease, push, ease, pushy. So you don't have huge candles. You don't have a big variance between the open and the close price of the previous candle to the current candle. Each one in an uptrend is closing slightly higher, but not dramatically higher. Now, leveraged products have a potential for larger profits but equal losses. So we've kind of touched on this all before. Keep in mind that when you have higher volatility and you're using leveraged products, you have the potential for huge market swings, which can mean that you can get easily stopped out. So volatility trading has the potential to provide big rewards when using leverage, but also big losses. Whether trading a volatile market or not, risk management is paramount. Stop losses should always be used, and the need for consecutive execution tools increases at volatility or leverage increases. And keep in mind, you should always, always, always be looking at specific exit strategies that are designed for specific volatile markets, as well as understanding how to calculate where you need to put your stop loss, not to get stopped out on the swings of the market. Simply put, there are many ways for you to have an exciting time trading the markets. While every methodology laid out here has its merits, they also have potential risk for unmitigated disaster. Being laser focused on managing risk and making sure that your spontaneity doesn't turn to recklessness is a vital component for trading in the long term. So that's all for tonight, folks. Thank you very much for joining us, and I hope you learned a little bit about volatile markets. Bye now.